Every trader's journey often begins with the same story. A small account, maybe $100, maybe even less. At first glance, it looks harmless. Just a little experiment, a chance to dip your toes into the market. But in reality, that small account can become the biggest trap of your entire trading career if you approach it with the wrong mindset. The moment you deposit that money, two conflicting thoughts battle inside your head. The first tells you it's not a big deal, that if you lose it, you'll just move on. The second tells you it could be the ticket to something huge, that if you play it right you might flip it into thousands and escape your job, your stress, your current life. These thoughts seem harmless, but they set the stage for reckless behavior. When the account feels disposable, you stop respecting it. And when you believe it could make you rich overnight, you start gambling instead of trading. Both lead down the same path: account destruction. Social media adds fuel to the fire. You scroll past screenshots of traders who claim to have turned 200 into 500 in a week. You see fast cars, luxurious lifestyles, and bold captions about financial freedom. It's seductive. It convinces you that with just a few bold trades, you could be next. But what you don't see are the thousands of accounts that vanish trying to do the same. What you don't see is the emotional roller coaster that tears traders apart long before they ever reach consistent profits. Here's how it plays out. You take your first trade, and it works. Maybe you grow your $100 into $120. You feel unstoppable. The brain releases dopamine, and suddenly the idea of doubling your account doesn't feel like a dream, it feels like a plan. But then the next trade goes against you. In seconds you're back at $80. The panic hits. You tell yourself you'll make it back quickly. You start chasing setups that don't exist. You take trades that don't fit any rules. You increase your size, telling yourself you just need one winner. And in doing so you step into the rookie trap, where logic disappears and emotion takes over. This emotional volatility is what destroys small accounts. One day you're riding high on a win, the next you're crushed by a loss, and the swing between those emotions blinds you to the bigger picture. You stop asking the right questions. Does this fit my plan? Am I risking an amount I can accept? Is the market actually giving me a signal, or am I just acting on fear or greed? Instead, you click buy or sell out of impulse, out of boredom, or out of desperation. That isn't trading. That's gambling. But here's the truth that most new traders miss: the size of the account doesn't matter. What matters is how you treat it. $100 is not supposed to make you rich. It's supposed to teach you discipline. It's not about profit, it's about practice. Think of it like a gym membership. Nobody expects to walk into the gym, lift weights once, and walk out with a perfect body. The gym is where you build form, routine, and consistency. Your small trading account works the same way. It's your training ground. It's where you learn to respect risk, control emotion, and follow process. Respecting a small account means treating every dollar as if it were 1,000. It means protecting it, nurturing it, and using it to develop the habits that will one day allow you to manage larger sums responsibly. Because here's the thing: if you can't grow $100 slowly and consistently, you won't be able to grow 10,000. The market doesn't magically reward you with better discipline when you add more money. In fact, the opposite happens. Bad habits get amplified. That's why the real key isn't speed, it's compounding. Compounding is the invisible engine of wealth. At first, it looks small, almost insignificant. Growing by 1% or 2% in a week doesn't sound impressive. But let that same growth repeat, let it build over months and years, and suddenly you see the power. $100 won't turn into $1 million overnight, but the habits you build with that 100 can compound into skills, confidence, and financial results that last a lifetime. The rookie trap, then, isn't just about losing money, it's about losing patience. Impatience makes you over-leverage, revenge trade, and ignore risk management. It makes you sabotage your own progress because you're desperate for fast results. And once you blow up a few accounts, the damage goes deeper than the money itself. You start doubting your ability, questioning whether trading is even for you. That loss of confidence can take longer to repair than the dollars you lost. The antidote is structure. Before you enter a trade, you need clarity. Is this part of my plan? Is the risk acceptable? Am I acting out of discipline or out of emotion? If you can't answer those questions clearly, you don't click. That's how professionals think. That's how traders separate themselves from gamblers. Think of your account as a seed. If you plant it and water it, it grows over time into something bigger. But if you keep digging it up, checking it, and hoping it becomes a tree overnight, you kill it before it even has the chance. Your $100 account is that seed. Handle it with patience, respect, and consistency, and it can grow, not into riches tomorrow, but into the foundation of a trading career that actually lasts. And here's a perspective shift: starting small is not a disadvantage, it's an advantage. A small account forces you to build discipline. It forces you to manage risk carefully. It forces you to learn lessons with small losses rather than devastating ones. If you can master your emotions and stick to your process on $100, you're preparing yourself to handle 10,000 or 100,000 in the future. But if you gamble with a small account and get lucky, those bad habits will scale with you, and when you trade larger amounts, the destruction will be even faster. So the rookie trap is simple. New traders see small accounts as disposable tickets to quick riches. But the truth is, those accounts are not lottery tickets, they are training tools. If you chase fast money, you'll end up broke and discouraged. If you respect the process, focus on compounding, and use the small account to practice discipline, you'll build skills that outlast any single trade. This is the first lesson every trader must learn. Respect small accounts. Build discipline. Adopt the compounding mindset, because if you can survive and grow slowly here, you're preparing yourself for the real game ahead. Trading is not about heroics. It's not about the thrill of the biggest win or the rush of adrenaline from a risky bet. Yet, that's exactly what most new traders chase. The truth that separates amateurs from professionals is simple: slow, steady growth beats reckless gambling every time. It's not flashy. It's not exciting, but it works, and it's how fortunes are built quietly over time. Compounding is the engine of trading success. Small gains, repeated consistently, accumulate into significant growth. 1% here, 2% there, week after week, month after month. It doesn't sound like much in the moment, but over a year, it multiplies. This is why legendary traders focus on patience, discipline, and emotional control rather than chasing the big win. Warren Buffett, for instance, built his empire by compounding returns over decades, rarely letting short-term excitement dictate his decisions. Jesse Livermore and Richard Dennis mastered the markets not through constant action, but by waiting for the right setups and protecting their capital when the market was uncertain. They understood a simple principle: growth is a marathon, not a sprint. The foundation of compounding is risk control. Protecting your capital is more important than seeking quick profits. Each trade carries uncertainty, and the market will punish overconfidence. By limiting risk, you survive losses without fear. You avoid emotional blowups, and you maintain the confidence to keep trading. Small, calculated gains build your account steadily and, more importantly, build your mental resilience. This is how discipline grows into a long-term advantage. To succeed, you must avoid ego-driven trades. Many traders fall into the trap of taking unnecessary risks to prove something, to themselves, to others, or to the market. That mindset is lethal. Every trade should serve a clear purpose based on probability and preparation, not pride or emotion. Treat trading as a science, not a game of one-upmanship. Losses will happen. Compounding doesn't prevent losses. It teaches you how to handle them. Each losing trade is a lesson. Review them, understand them, and let them inform your next decision without letting them cloud your judgment. This is why professional traders view trades as probability events rather than instant wins or losses. No single trade defines your success. The cumulative results over time do. Emotional control is critical. Adrenaline-driven trades might feel exciting, but they rarely produce consistent results. Discipline, the ability to follow your rules, wait for setups, and manage risk, beats adrenaline every time. Patience is not passive. It's active waiting, observing the market, analyzing, and only acting when conditions meet your criteria. Legendary traders didn't sit idle because they were scared. They waited because they knew the edge only appears at certain moments. Respect for market unpredictability is part of the compounding mindset. The market is never easy, and it will always surprise you. You can't control outcomes, only your approach. Accepting this uncertainty keeps you humble, prevents rash decisions, and strengthens your mental stability. Traders who react emotionally to every market swing are eventually broken by it. Those who maintain composure and trust their process, even through drawdowns, last. The mental stability required for compounding cannot be overstated. Every win feels good, but it's easy to become overconfident. Every loss feels painful, but it's easy to become reactive. A compounding mindset teaches you to see both outcomes as neutral, opportunities for learning, and part of a long-term equation. Emotional neutrality allows you to make decisions based on probability and logic rather than fear or greed. Think of compounding like planting a tree. You water it consistently, even when growth seems invisible. You don't dig it up every day to see if it's taller. You trust the process, knowing that over months and years, your patience and care produce results that dwarf any single action. Trading works the same way. Your small gains, carefully preserved and allowed to compound, create results that are far greater than any impulsive, risky win ever could. Let's bring in some examples. Warren Buffett's approach is simple: buy quality, manage risk, and let time amplify results. Jesse Livermore emphasized timing and waiting for optimal opportunities, avoiding trades that weren't clear-cut. Richard Dennis built the turtle trading experiment on rules, patience, and letting probabilities work in his favor over time. What all of these traders shared was not luck, it was discipline, patience, and respect for the process. They understood that compounding is more powerful than heroics, and mental stability is worth far more than short-term thrills. Every day you trade with a compounding mindset, you reinforce habits that protect capital, strengthen your confidence, and improve your decision-making. You learn to control emotions rather than letting them control you. You learn that wealth is built slowly, steadily, and consistently, not in bursts of luck. You see losses as temporary setbacks and small gains as building blocks. You trade for the long game, knowing that patience compounds into advantage. This mindset changes everything. Suddenly, you're not chasing wins. You're focused on the process. You're observing, analyzing, and waiting. You're treating your account as a seed to nurture rather than money to gamble. You're not driven by fear or greed. You're guided by rules, probabilities, and consistency. The compounding mindset turns the market's unpredictability from a threat into a partner, where careful planning and discipline gradually produce measurable, lasting results. In the next step, we'll take this mindset even further, exploring what I call ruthless patience. You'll learn how to master waiting, how to suppress impulse, and how to let the market reveal its opportunities while you remain calm, disciplined, and uncompromising in your approach. Because compounding is only the beginning. To truly succeed, you must combine it with a level of patience that most traders never develop. Master slow, steady growth. Respect risk. Control emotions. Let time and compounding do the heavy lifting. That is how small gains turn into extraordinary results, and how mental stability outperforms adrenaline every single time. Patience is the most underrated skill in trading. Most traders believe they need to be constantly active, watching every candle, jumping on every tick, trying to never miss a move. The reality is exactly the opposite. The market does not reward activity, it rewards precision, discipline, and the ability to wait for the right opportunity. True traders learn that sometimes, the best action is inaction. Every candle is an invitation, every tick is a temptation. The market is designed to trigger impatience. It flashes, it moves, it teases. For new traders, it feels urgent, like missing a single move will destroy your chance for profit. But that thinking is lethal. Impatience kills accounts faster than any bad trade ever could. The key is understanding that not every market movement is a trade. Most are noise. Most are distractions from the setups that actually have an edge. Ruthless patience means waiting actively. This is not passive boredom, it is disciplined observation. You study price action, analyze structure, and prepare yourself mentally for the moment when all conditions align. That moment may come once a week, once a month, or even less. Legendary traders sometimes take as few as 4 trades per month. It sounds shocking to a beginner, but the math is simple. One high-probability trade executed correctly often outweighs dozens of impulsive, poorly planned trades. The market constantly tempts you to act. Every small movement triggers an emotional response. Excitement, fear, greed. These emotions urge you to click buy or sell, even when nothing meets your criteria. A candle that almost fits your plan feels like an opportunity. A tick that spikes in your favor feels like a signal. But experienced traders recognize these as distractions, traps designed to exploit human impatience. Ruthless patience means resisting these temptations, no matter how enticing they feel. High-probability trades are the only ones that matter. They are rare by design, and that rarity is what makes them profitable. Trading fewer, better setups preserves capital, protects your mental state, and allows compounding to work its magic. Each trade taken without full confidence is a step backward. Each trade executed perfectly is a step forward. Over time, the results compound, not in the number of trades taken, but in the quality of decisions made. Doing nothing is a trade. This concept is counterintuitive for most beginners. Watching the market move without acting feels frustrating, even boring. But doing nothing when conditions aren't ideal is more profitable than forcing action. The mental reward of waiting is subtle but powerful. Confidence grows, discipline strengthens, and emotional control becomes automatic. You learn to see the difference between market noise and true opportunity. Waiting actively develops patience like a muscle. At first, it is uncomfortable. You feel anxiety, fear, and doubt creeping in. What if I miss it? You ask yourself. That fear is precisely why the exercise is necessary. By resisting the urge to act, you train your mind to focus on quality over quantity. Over time, patience becomes instinctive. You no longer fight the market, you work with it. You recognize setups quickly, act decisively when they appear, and remain calm when they don't. The mental rewards of ruthless patience extend beyond the charts. When you are patient, you feel in control. You aren't slaves to every fluctuation, every candle, every tick. You build trust in yourself and your process. You know that opportunities will come and you don't have to chase them. This calm confidence is an edge that most traders never develop because they are too busy reacting to every minor market movement. Risk versus reward becomes clearer through patience. By waiting for high probability setups, you limit exposure and maximize potential gain. Instead of risking capital on marginal trades, you allocate resources to setups with defined risk and higher likelihood of success. Each patient trade carries meaning, each impulsive trade carries danger. By contrast, most traders who act constantly dilute their risk-reward balance, overextend emotionally, and slowly erode their accounts. Patience ensures that every trade counts. Let's look at a case study. Imagine a trader who executes only 4 trades in a month. Each trade meets strict criteria: technical alignment, market context, risk control, and high probability of success. Instead of making dozens of impulsive trades that may break even or lose money, this trader focuses entirely on the quality of each entry. Over the month, the cumulative gains from these 4 trades often surpass the results of a trader who takes 10 times more trades with lower probability. The lesson is simple: it's not about activity, it's about precision. Ruthless patience also teaches emotional resilience. Every trader faces drawdowns and missed opportunities. A trader without patience reacts emotionally, overtrades, and often escalates losses. A patient trader absorbs the same market movements with calm, recognizing that missed trades are not failures. They are opportunities waiting for the right conditions. Patience becomes a shield against emotional decision-making, protecting both capital and confidence. The market is unpredictable. You cannot control when setups appear or when volatility spikes. You can only control your response. Ruthless patience allows you to respond optimally when conditions are right and to ignore distractions when they are not. Every instance of waiting strengthens your mental muscle, reinforces discipline, and deepens trust in your process. In trading, doing nothing can be the most profitable action. The ability to resist temptation to wait actively and to act decisively when the edge appears defines elite traders. Impatience may feel urgent and exciting, but it rarely leads to long-term success. Patience exercised consistently compounds into skill, confidence, and ultimately, profits. As you cultivate ruthless patience, you prepare for the next stage of trading mastery: emotional control. Patience alone is not enough if emotions override your logic during critical trades. In Part 4, we'll explore how to maintain mental stability, avoid emotional traps, and execute your strategy under pressure. Patience lays the foundation, but emotional control completes the structure. Remember, each candle is an invitation, each tick is a temptation, and every moment of restraint strengthens your edge. Trade less, trade better, and let patience do the heavy lifting. The market rewards those who wait actively, act decisively, and respect the power of doing nothing when conditions aren't perfect. That is ruthless patience. Trading is as much a mental game as it is a technical one. New traders often believe that strategy alone determines success, but the truth is far subtler. Even the best plan fails if emotions take control. Fear, greed, and FOMO, the 3 silent account killers, are magnified when you start small. A 100 or 500 account may seem insignificant, but emotionally each dollar feels enormous. Every loss, every missed opportunity, every social media post showing someone else's success can trigger reactions that cloud judgment and sabotage discipline. Small losses feel disproportionately large. A 5 loss in a 100 account might seem minor numerically, but the emotional response can be intense. Panic sets in. The mind whispers, "I can't afford this. I need to recover now." That panic tempts traders to abandon the plan, overtrade, or take reckless risks. Controlled traders, by contrast, respond with calm. They acknowledge the loss, assess why it happened, and move forward according to the rules they've established. Panic is temporary, discipline is permanent. Fear control starts with preparation. Define risk before you enter a trade, so the account is never exposed to emotional ruin. Accept that losses are part of the process. When you know you cannot lose more than a fraction of your capital, fear diminishes. You are free to focus on opportunity rather than survival. Emotional energy is a limited resource, and conserving it is essential. Wasting it on worry or regret weakens judgment and invites mistakes. Greed is the other side of the coin. Many traders overtrade because they want more than the market can safely offer, or because a winning streak makes them believe they are invincible. The compounding mindset counteracts greed by emphasizing consistency over size. Small, controlled gains repeated over time outperform chasing big wins impulsively. When you focus on process rather than outcomes, greed loses its grip. You trade fewer, higher quality setups, protecting both capital and mental stability. FOMO and social comparison are modern pitfalls. Watching others flaunt gains, or seeing screenshots of overnight success, triggers anxiety and envy. These feelings often lead traders to enter positions outside their strategy, break rules, or take excessive risk. Emotional discipline requires detachment from external signals. Your trading decisions are based on your edge, your preparation, and your plan, not the fear of missing out or the desire to keep up with others. Journaling is one of the most effective tools to maintain emotional control. By recording not just trades but your feelings before, during, and after them, you gain clarity. Patterns emerge: panic reactions, impulsive entries, revenge trades. Once you see them, you can address them consciously. Journaling turns unconscious emotional responses into actionable insights. It trains you to detach from results, focus on process, and approach each trade with clarity rather than reaction. Controlled decision making is the ultimate product of emotional discipline. Every entry and exit is guided by rules, probability, and preparation, not by fear, greed, or excitement. Detachment doesn't mean passivity. It means acting decisively only when the edge is present, without being swayed by emotional noise. Emotional discipline is the bridge between patience and execution. Without it, patience alone may be wasted. Without patience, discipline is hard to apply consistently. Together, they form a resilient foundation for trading. Revenge trading is a prime example of what happens when discipline falters. A single loss can trigger a chain reaction. You trade aggressively to recover, ignore your plan, and risk more than intended. Emotional discipline stops this cycle. By accepting losses as part of the compounding process, you neutralize the urge to act impulsively. You maintain composure, follow your risk rules, and focus on the next high-probability opportunity rather than attempting to win back what was lost. Ultimately, emotional discipline is about energy management. Fear, greed, and FOMO drain mental resources. By cultivating awareness, journaling your feelings, detaching from outcomes, and focusing on process, you preserve energy for high-quality decisions. Each trade is executed with control, every loss is treated as feedback, and every gain is measured with calm satisfaction. Emotional discipline allows you to trade confidently, scale positions responsibly, and compound results over time. As you master emotional discipline, you're ready for the next step: scaling with confidence. Now that fear, greed, and impulsive reactions are under control, the focus shifts to increasing capital while maintaining the principles that made small accounts successful. Scaling is no longer about chance, it's about systematic, controlled growth, guided by patience, process, and emotional mastery. Risk is often misunderstood by new traders. Many see it as a threat, a looming danger that could wipe out an account at any moment. But in reality, risk is a tool, not an enemy. Properly managed, it becomes one of your greatest advantages in the markets. Risk management is not just a technical concept, it's a mental edge. The ability to control risk determines whether a trader survives long enough to benefit from compounding and disciplined growth. The first step in mastering risk is position sizing. How much of your account do you put on a single trade? A common guideline is to risk only a small percentage, 1% or 2% per trade, so that even a loss does not threaten your overall account. This principle preserves capital and preserves mental stability. Losing a trade becomes a minor setback, not a crisis. Small accounts are perfect for learning this. They allow you to practice risk control on a scale where mistakes are inexpensive, but the lessons are invaluable. Stop-loss discipline is equally critical. Every trade should have a predefined exit point. Without it, traders rely on hope or emotion, often turning small losses into large ones. A stop-loss is not a failure, it is a protective measure, a guardrail that keeps the account intact. By consistently using stop-losses, you learn to detach from outcomes and focus on the process. You trade objectively, not emotionally. Scaling slowly is another pillar of risk management. As your account grows, position sizes can increase, but only gradually and proportionally. Each step up should feel comfortable, not forced. The market does not reward recklessness, and overexposure at higher capital levels is a fast track to account destruction. By mastering risk in small accounts first, you create a foundation of habits that carry seamlessly into larger balances. Every small loss is a lesson. Losing trades are not failures, they are feedback. When risk is controlled, losses are temporary and manageable. Analyze them, understand why they happened, and adjust your approach without panic. Over time, this mindset develops resilience and improves decision-making. Protecting capital consistently is more important than chasing profits. The trader who survives the drawdowns is the trader who has the opportunity to compound gains steadily over time. Risk-reward evaluation is at the core of every trade. You don't enter positions blindly. Each trade is assessed for potential gain versus potential loss. A favorable risk-reward ratio ensures that even if half your trades are losing trades, the net outcome is positive. By applying this rigor consistently, you create a system where discipline, patience, and probability work together. Trade preparation is part of risk management. Every setup should be analyzed before a single order is placed. Know your entry, your stop loss, your target, and the maximum risk you are willing to accept. This preparation prevents impulsive decisions and reinforces mental clarity. When you step into the market prepared, fear and greed have less influence over your actions. Avoiding overexposure is critical. Many traders compound their own mistakes by allocating too much to a single trade or concentrating positions in correlated markets. Diversification, adherence to percentage risk per trade, and awareness of overall portfolio exposure reduce volatility and protect the account from catastrophic loss. Controlled exposure ensures you can survive the inevitable drawdowns and stay in the game long enough for compounding to take effect. The mental edge of risk management cannot be overstated. Knowing that each trade is properly sized, that every loss is contained, and that capital is protected builds confidence. That confidence allows you to wait for high-probability setups, execute your strategy calmly, and resist emotional temptations like revenge trading or chasing profits impulsively. Without this mental edge, even the best strategies fail under pressure. Small accounts are a perfect environment to develop these skills. By risking tiny percentages using disciplined stop losses and learning from manageable losses, traders build habits that scale naturally. These habits are transferable. The discipline you cultivate with a 100 account is the same discipline that protects a 10,000 account. The only difference is size, not mindset. Ultimately, risk management is about control. You can't control the market, but you can control how much of your account is at stake, how you respond to losses, and how you protect your future opportunity. Capital preservation comes first, profits come second. This approach may feel slow or conservative at first, but over time it produces consistent, sustainable results that reckless traders can only dream of. As you master risk management, you are ready for the next steps, establishing routines and habits. A strong system of daily practices ensures that discipline, patience, and risk awareness are applied consistently, day in and day out. Without routines, even the best principles fail. But with them, the foundation for long-term trading success is built. Professional traders know that success is not born from luck or talent alone. It is built through consistent habits, routines, and preparation. Markets are unpredictable, fast-moving, and emotionally charged. The edge of a professional trader comes not from guessing the next move, but from being mentally ready, disciplined, and structured every single day. Daily habits create this readiness, turning preparation into a strategic advantage. Morning routines set the tone. Before the market opens, professionals take time to center themselves. This can include meditation, visualization, or simple focus exercises. Meditation clears the mind of distractions and reduces emotional reactivity, while visualization allows traders to mentally rehearse scenarios of perfect entry, managing a loss, staying patient through drawdowns. By seeing these situations in advance, the mind reacts calmly when real decisions arise. This mental rehearsal is not theoretical, it builds reflexive discipline. Journaling is a cornerstone of professional habits. Every trade, every feeling, every decision is recorded and reflected upon. Traders don't just note wins or losses, they record why a trade was entered, how it felt emotionally, and what lessons emerged. Journaling creates self-awareness, turning unconscious reactions into conscious understanding. Over time, patterns emerge: emotional triggers, recurring mistakes, and successful strategies. This reflection allows professionals to improve systematically instead of repeating the same errors endlessly. Planning the day is another critical habit. Professionals don't react to the market, they plan their actions in advance. They review key levels, market conditions, and setups that fit their strategy. Every decision is guided by preparation, not impulse. By planning, they remove chaos and uncertainty from their trading environment, allowing discipline and strategy to guide execution rather than emotions. Structure replaces reaction, and opportunity is acted upon, not chased. Small trades are also part of the daily routine, even when the account is limited. They are not about profit, they are practice. Testing patience, managing risk, and executing the plan on low stakes builds mental muscles that will carry into larger trades. This, training in action, reinforces patience, emotional control, and process adherence. Even minor mistakes in small trades are valuable. They become lessons without catastrophic consequences. Reflection on mistakes is non-negotiable. Professionals don't ignore errors or rationalize bad trades. Every mistake is analyzed, understood, and incorporated into strategy adjustments. This reflection is a daily habit that ensures growth and prevents repetition. Success in trading is cumulative, and learning from mistakes is a critical part of that accumulation. Journaling combined with reflection forms a feedback loop, constantly improving decision-making and mental resilience. Reviewing strategy regularly is another habit that separates disciplined traders from amateurs. Markets evolve, volatility changes, and setups shift over time. Professionals revisit their methods, evaluate what works, and refine their approach. This ensures they are not rigid or reactive, but adaptive while still following structured principles. Without review, strategies stagnate, and emotional responses begin to dominate. Daily habits keep traders aligned with both process and market reality. Tracking progress and consistency is equally important. Professionals measure results beyond just account balance. They track adherence to rules, execution quality, emotional responses, and risk management. This broader view highlights strengths and exposes weaknesses that account performance alone may hide. Consistency in habits creates compounding growth in skill, mindset, and results, which ultimately translates into better financial outcomes. Mental readiness is the ultimate edge. A trader who starts the day unfocused, anxious, or reactive will struggle to execute a strategy no matter how well designed it is. Habits like journaling, meditation, visualization, and reflection prepare the mind to act calmly under pressure. They make patience instinctive, discipline automatic, and strategy the guiding force rather than emotion. Mental readiness is what turns preparation into opportunity and uncertainty into control. Ultimately, daily habits are the foundation of professional trading. They transform reactive impulses into deliberate action, mistakes into lessons, and small accounts into training grounds for long-term success. Habits bridge the gap between knowledge and execution. Without them, even the best strategy or mindset falters under the pressure of real markets. With them, traders are equipped to navigate volatility, maintain discipline, and capitalize on opportunities consistently. As these habits take root, you are ready for the next step, adapting to the market. The combination of preparation, journaling, reflection, and mental readiness allows traders to remain flexible, adjust strategies as conditions change, and thrive in environments that punish the unprepared. Habits create the framework for adaptation, and adaptation ensures survival and growth. Professional trading is a daily practice, not a one-time event. Morning routines, journaling, meditation, focused planning, and reflection form a cycle that reinforces skill, mindset, and emotional control. By treating each day as an opportunity to strengthen these habits, traders gain a consistent edge over those who trade impulsively or reactively. Structure over chaos, preparation over improvisation, and reflection over ignorance. This is the formula that turns potential into results. Every trader enters the market with a plan. Some stick to it, others abandon it the moment emotions rise. But the truth is this: no plan survives unchanged. Markets evolve. Conditions shift. Strategies that worked last year may fail this year. The traders who survive and grow are not the ones who never lose, but the ones who adapt and learn. Losses are inevitable. They are not signs of failure, but part of the trading plan itself. Every system, no matter how strong, produces losing trades. Professionals accept this truth deeply. They don't panic when a trade goes wrong, and they don't celebrate excessively when one goes right. Instead, they treat each result as information. A loss is not an attack on their identity. It is feedback. It shows what needs to be adjusted, what risk levels are appropriate, and how the market is currently behaving. The danger lies not in the loss itself but in how traders react to it. Emotional reactions, panic selling, revenge trading, or doubling down recklessly, only magnify damage. Rational analysis, on the other hand, transforms a setback into progress. Professionals step back and ask, why did this trade fail? Was it poor execution, or was it simply part of normal probability? This distinction matters. One demands correction, the other demands patience. Without rational analysis, traders stay trapped in cycles of emotional reaction. Cognitive biases play a massive role in trading mistakes. One of the strongest is loss aversion. Humans feel the pain of losing twice as strongly as the joy of winning. This bias can push traders to cut winners too early and hold losers too long, hoping the market will turn around. Another bias is anchoring, fixating on a certain price or belief about where the market should go. Anchoring blinds traders to reality, making them cling to trades long after evidence says they should exit. Recognizing these patterns is critical. Professionals don't pretend they're immune to bias, they learn to spot it. Journals, self-reflection, and mentorship help expose recurring traps. Once recognized, biases lose their invisible grip and decisions become clearer. Every failed trade contains a lesson if you're willing to look. Was your entry based on solid strategy, or was it driven by FOMO? Was your stop loss too tight, or did you fail to respect market volatility? Was your position size aligned with your risk tolerance? Each mistake carries information. The professionals don't hide from them, they dissect them. Over time, these lessons stack, building intuition and discipline. But learning doesn't mean rewriting your entire system after every mistake. A key difference between amateurs and professionals is knowing when to update rules versus when to trust the process. Professionals refine strategies gradually. They adapt entries, adjust risk levels, and modify rules based on evidence, not emotions. Habits like discipline, patience, and journaling remain constant. It is the tactical details that evolve. Adaptation also requires patience. You cannot judge a strategy on one trade or even 10 trades. Probabilities play out over time. Professionals balance patience with adaptability. They wait long enough to gather meaningful data, but they remain flexible enough to adjust when markets clearly change. This balance is a skill. Too rigid, and you break when the market shifts. Too reactive, and you chase every candle. Mentorship and observation accelerate this process. Learning alone is slow and blind spots are hard to see. A mentor, whether through books, videos, or direct coaching, provides perspective. Observing how seasoned traders handle losses, adapt strategies, and maintain discipline offers invaluable models to emulate. Even watching how professionals speak about markets, calm, detached, focused on probabilities, can reshape your mindset. Markets evolve constantly. Technology changes speed. Global events shift sentiment, and patterns morph as more traders learn them. What worked 5 years ago may be obsolete today. The mindset must evolve with the market. This does not mean chasing every new indicator or fad, but maintaining openness to growth. Professionals stay students forever. They refine, adapt, and update without letting ego lock them into outdated beliefs. For small account traders, adaptation and learning are even more crucial. A 100 account is not just capital, it is a laboratory. Every loss is a small tuition fee in the University of Markets. Every adjustment sharpens awareness. In small accounts, the goal is not profit maximization, it is skill acquisition. The patience to adapt here builds the foundation for scaling later. Adapting is not about abandoning discipline, it's about upgrading discipline. Each loss teaches, each bias revealed strengthens awareness, each adaptation makes the trader sharper. Those who resist change, cling to ego, or refuse to acknowledge feedback stay stuck. Those who embrace adaptation grow into professionals. This is the ongoing journey of trading, not to conquer the market, but to learn from it, to adjust with it, and to grow because of it. Losses stop being threats. They become stepping stones. Every adaptation is a brick in the wall of resilience. And as this adaptability develops, it leads naturally to the next stage: confidence without arrogance. The trader who has endured losses, recognized biases, and adapted strategies gains real confidence. Not from illusions of invincibility, but from experience. This confidence fuels consistent execution while keeping ego in check. Confidence is one of the most valuable assets a trader can possess. Without it, hesitation creeps in, decisions become shaky, and opportunities slip away. But confidence in trading is often misunderstood. Many mistake arrogance for confidence, believing they know where the market is going or that they cannot be wrong. Arrogance blinds a trader, creating recklessness and ego-driven decisions. True confidence is the opposite. It's humble, grounded, and earned through preparation, backtesting, and reflection. Confidence comes from preparation. A trader who begins the day with a clear plan, levels marked, scenarios rehearsed, risks defined, trades differently than one who enters blindly. Preparation removes guesswork, replacing it with clarity. When the trade comes, execution feels natural, not forced. Professionals don't rely on hope, they rely on preparation, and this creates calm, quiet confidence. Backtesting is one of the most powerful confidence builders. By testing a strategy across hundreds of trades, across different market conditions, a trader gains statistical awareness. They see the probabilities for themselves, the win rate, the drawdowns, the risk-reward profile. Backtesting transforms belief into evidence. With evidence, trust in the system grows. When a loss occurs, the trader does not panic, because the data already showed losses are part of the game. Each trade becomes one of many, not a life or death event. Reflection after every trade deepens this confidence. The professional does not simply move on after closing a position. They ask, did I follow my plan? Was my decision aligned with my rules? Did emotions interfere? Over time, reflection highlights strengths and reveals weaknesses. By correcting mistakes and reinforcing good habits, reflection builds reliability. Confidence is not about never failing, it is about knowing you can adjust, recover, and improve consistently. Avoiding ego-driven decisions is another core principle. Confidence without discipline easily slips into arrogance. Arrogance says, I can't lose. Confidence says, I trust my process even when I lose. The difference is subtle but critical. Ego demands constant wins, confidence accepts probability. Ego forces trades, confidence waits for setups. Ego compares itself to others, confidence compares only to yesterday's self. Incremental growth reinforces this mindset. Confidence does not come from doubling an account overnight. It comes from stringing together small wins, controlling risk, and gradually compounding results. Each step forward, whether it's a profitable week, a well-executed trade, or simply following the rules, adds another brick to the wall of confidence. Growth built slowly is stronger, more stable, and less likely to crumble when challenges appear. Small wins compound confidence just like capital. A day of following rules, even if it ends break-even, is a win. A trade where you stuck to your stop-loss instead of moving it is a win. Confidence grows not only from outcomes but from actions. Each disciplined decision confirms your ability to trade like a professional, and over time, these confirmations create unshakable trust in yourself. Avoiding comparison to others is also key. Social media forums and online communities are filled with traders posting massive profits. For beginners, this creates doubt. Why am I not making that much? Am I falling behind? But comparing journeys is poison. Confidence is personal, built internally, not externally. Another trader's success or failure has nothing to do with your process. By focusing inward, on your strategy, your rules, your progress, you protect your confidence from the destructive influence of comparison. Celebrating the right things cements confidence further. Amateurs celebrate big wins. Professionals celebrate discipline. Closing a trade in profit feels good, but closing a trade according to your rules, whether it wins or loses, is where real confidence grows. Every time you prove to yourself that you can follow your process under pressure, your identity as a disciplined trader solidifies. The celebration is not in the outcome, but in the execution. Confidence is not instant. It builds through consistency, day by day, rule by rule, reflection by reflection. It grows slowly but becomes unshakable because it is based on evidence, not ego. When you've prepared, backtested, reflected, and grown incrementally, no single trade can shake your foundation. You know who you are as a trader, and that identity guides your actions. The beauty of confidence is that it transforms how you experience the market. Instead of fear and hesitation, you feel calm and deliberate. Instead of overtrading, you wait. Instead of chasing, you trust. Confidence removes noise and replaces it with focus. And in trading, focus is everything. Ultimately, confidence without arrogance is the balance that keeps traders alive. Confidence gives you courage to act when opportunity appears. Arrogance convinces you to act even when no opportunity exists. Confidence keeps your ego in check. Arrogance blinds you to reality. The trader who finds this balance, the trader who builds true confidence from preparation, backtesting, reflection, and discipline, earns not just profits but longevity. And as this confidence develops, it creates the foundation for the next stage, scaling with intention. With confidence built on discipline and process, traders are ready to grow their accounts without succumbing to arrogance. Scaling requires the same patience, risk management, and emotional control. But now confidence provides the stability to expand wisely. Scaling is the stage every trader dreams of, growing from a small account into something bigger, something meaningful. But scaling is not about throwing more money into the market and expecting multiplied returns. It's about carrying the same discipline, the same process, and the same mindset into larger positions without letting emotions sabotage progress. Scaling must be slow. Professional traders understand that accounts grow step by step, not in leaps. When the account balance increases, the risk per trade increases proportionally, but the percentage remains the same. If you risked 1% on a 100 account, you risk 1% on a 10,000 account. The discipline doesn't change, the numbers do. This is the essence of consistency. Consistent percentage risk is the anchor of scaling. Many traders get excited when their capital grows and begin risking more than their system allows. The temptation to accelerate growth is strong, but impulsive scaling destroys accounts. By keeping percentage risk constant, you preserve capital and mental stability. A loss feels manageable, whether it's 10 or 100,000, because it's always aligned with your rules. Emotional control becomes even more important with bigger accounts. Watching larger dollar amounts rise and fall can easily trigger fear, greed, or panic. Without discipline, traders sabotage themselves, cutting trades early, overtrading, or chasing opportunities. Professionals avoid this trap by focusing on the process, not the dollar figure. The trade is the same, whether small or large. The numbers grow, but the mindset must remain steady. Tracking growth is another pillar of disciplined scaling. Professionals don't measure success by a single trade or even a single day. They look at weeks, months, and years. They track progress across dozens or hundreds of trades, knowing that probabilities play out over time. This long-term view prevents the emotional roller coaster of judging success based on short-term fluctuations. Avoiding the urge to chase opportunities is critical. As accounts grow, the temptation to put money to work increases. But more capital doesn't mean more trades. Scaling is about doing the same thing you did before, executing high-quality setups, respecting risk, and waiting patiently. The market doesn't care how much you've scaled, the same traps are there, and impatience remains the most dangerous. A focus on risk-adjusted reward keeps discipline intact. It's not about how much you make. It's about how much you make relative to what you risk. Professionals know that protecting downside is more important than chasing upside. With scaling, this becomes even more crucial because mistakes cost more. Preserving capital is the first priority. Profits follow naturally. Equally important is preserving mental capital. Trading larger accounts is mentally demanding. Each decision carries more weight, and the pressure can accumulate. Professionals protect their mental energy by following routines, journaling emotions, and maintaining balance outside of trading. Without mental clarity, even the best strategies collapse under stress. At its core, scaling is about respect for the market, respect for risk, and respect for yourself as a professional. Treating trading as a system, not a gamble, ensures growth is sustainable. Professional identity is built on system-based thinking, following rules, executing plans, and adapting when necessary. Scaling without discipline is gambling with bigger stakes. Scaling with discipline is building a career. As you master scaling with discipline, you're ready for the final stage: trading mastery and long-term success. This is where everything comes together: mindset, risk management, patience, confidence, and adaptability, into a sustainable approach that lasts for years, not months. Mastery in trading is not about finding the perfect strategy or predicting the market with absolute certainty. It's about building a professional identity, seeing yourself as a trader who follows a process, manages risk, and plays the long game. At this stage, trading stops being a hobby or a side hustle. It becomes who you are, a craft that shapes the way you think, decide, and live. The difference between a professional and a gambler is mindset. Gamblers look for excitement. They crave the rush of the next big win, chasing shortcuts and ignoring rules. Professionals, on the other hand, crave consistency. They measure success not by how much they make in one trade, but by how well they protect their capital and follow their system. In trading, survival is victory, and survival comes from discipline. One of the most overlooked signs of mastery is measuring success by preserved capital. Beginners celebrate profits, professionals celebrate protection. Every dollar not lost is fuel for the compounding engine. Capital is your business, your lifeline. Protect it ruthlessly, and it will grow steadily over time. Lose it recklessly, and the game ends. Patience becomes an active skill at this level. It's not waiting passively. It's waiting with discipline, focus, and readiness. Professionals pass on countless trades that don't meet their criteria. They know that saying, no, is as powerful as saying, yes. Every impulsive trade avoided is a victory in itself. Mastery is built not only on what you do but on what you refuse to do. Impulsiveness has no place in long-term success. A single reckless trade can undo months of progress. That's why sticking to your strategy, no matter what, is the mark of true professionalism. Even when the market tempts you, even when emotions push you toward shortcuts, mastery means honoring the rules you've built. Your edge lies not in reacting but in staying aligned with your system. Long-term compounding is the silent force behind mastery. It's not flashy, it doesn't impress on social media, but it's unstoppable. A small account treated with respect grows over time into something meaningful. Each disciplined decision adds up, brick by brick, into a foundation that can support decades of trading. Professionals understand this and avoid chasing overnight success. They choose compounding over shortcuts because they know time is the greatest ally. The market rewards discipline. It punishes recklessness. Over the long run, the traders who last are not the boldest or the smartest. They're the ones who consistently follow their edge, manage their risk, and protect their mental capital. Mastery is not about intensity, it's about endurance. The ability to stay in the game long enough for probabilities to play out is what separates the survivors from the casualties. A small account is not a weakness, it's a training ground. It's where you prove to yourself that you can follow rules, stay patient, and grow with discipline. If you can't respect a small account, you won't respect a big one. Mastery starts with treating every dollar as important, no matter the size. In the end, mastery is not about excitement, it's about consistency. True professionals find satisfaction not in adrenaline but in routine, in execution, in knowing that every trade is a step toward their vision. They understand that the market is infinite, but their capital and their discipline are not. Protecting both is the foundation of lifelong trading success. This is the long-term vision: to build a trading career not measured in days or weeks, but in years and decades. To approach markets with humility, patience, and respect. To treat trading not as a gamble, but as a profession, a mindset that creates stability, growth, and freedom for a lifetime.